Hey everyone, and welcome back to the channel. Do you ever feel like you're stuck in a loop? You look at your bank account, see a little bit of extra cash, and think, what can I even do with this? It's not enough to invest. Well, I'm here today to bust that myth wide open. That feeling of not having enough to start is one of the biggest hurdles holding people back from building wealth. But the truth is, you don't need a huge lump sum to get started. In fact, starting small is one of the smartest things you can do. Today, we're going to break down 10 powerful investment moves you can make with small amounts of money. So grab a notepad, because by the end of this video, you'll have a clear roadmap to turn your small change into a serious financial future. Let's get into it. First up, and this is a game changer for beginners, is investing in high-yield savings accounts and certificates of deposit, or CDIS. Now, I know what you're thinking. Isn't that just a savings account? Yes, but with a supercharge. A high-yield savings account offers an interest rate that is way higher than what you'd get at a traditional brick-and-mortar bank. While it's not going to make you a millionaire overnight, it's a zero-risk way to make your money work harder for you. It's the perfect place to park your emergency fund or short-term savings, letting it grow while you plan your next move. Then we have CDIS. With a CD, you agree to lock your money away for a specific term, say 6 months or a year, in exchange for an even higher, fixed interest rate. It's a fantastic, low-risk option if you have money you know you won't need to touch for a little while. The key here is to outpace inflation, and these tools are your first line of defense. Move number 2 is to embrace the power of robo-advisors. If the thought of picking individual stocks makes you break out in a cold sweat, this is for you. Robo-advisors are automated platforms that use algorithms to build and manage a diversified investment portfolio for you. You simply answer a few questions about your financial goals and your risk tolerance, and the platform does the rest. It's like having a financial advisor but at a fraction of the cost. Many of these platforms let you start with as little as $1. They'll automatically invest your money in a mix of low-cost exchange-traded funds, or ETFs, which we'll talk more about in a bit. They also handle things like rebalancing your portfolio to keep you on track. It's the ultimate set-it-and-forget-it strategy for beginners who want to get into the market without the stress. Our third smart move is to invest in low-cost index funds and ETFs. This is where the magic of diversification really comes into play. Instead of trying to pick the one winning stock out of thousands, an index fund or ETF lets you buy a tiny piece of the entire market. For example, an S&P 500 index fund holds stocks from the 500 largest companies in the US. When the market as a whole goes up, so does the value of your investment. This strategy, famously championed by investing legends like Warren Buffett, is all about playing the long game. The fees are incredibly low, and because you're so diversified, your risk is spread out. You can buy shares of these funds through any major brokerage account, often with no minimum investment. It's a simple, proven way to build long-term wealth. Next up, strategy number 4, dividend reinvestment plans, or DRIPs. This sounds complicated, but it's beautifully simple. When you own a stock that pays dividends, that's your share of the company's profits. With a DRIP, instead of receiving that dividend as cash, it's automatically used to buy more shares of that same stock. This creates a powerful compounding effect. Your new shares then earn their own dividends, which buy even more shares, and so on. It's a snowball of wealth that grows over time. Many companies offer DRIPs directly, or you can set them up through your brokerage account. It's an amazing way to automate your growth and put your investments on autopilot, turning small, regular payouts into a significant holding over the long term. Let's move on to number 5, utilizing micro-investing apps. These apps are specifically designed to make investing accessible to everyone, no matter how small your budget. They work by letting you invest your spare change. For example, when you buy a coffee for $3.50, the app can round up your purchase to $4 and automatically invest that extra 50 cents for you. It might sound like just pennies, but you would be absolutely shocked at how quickly those small amounts add up. Over months and years, this consistent, automatic investing can grow into a substantial portfolio. These apps are user-friendly, they handle all the complex stuff for you, and they prove that every single penny truly counts on your journey to financial freedom. Our sixth strategy is a big one. Contribute to a retirement account like a 401k or an IRA. If your employer offers a 401k with a company match, you need to be taking advantage of it. That match is literally free money. For example, if your company matches 100% of your contributions up to 3% of your salary, and you contribute that 3%, you're instantly doubling your investment. There is no other investment out there that offers a guaranteed 100% return. If you don't have a 401k, open an individual retirement account, or IRA. You can contribute small amounts regularly. The money you put into these accounts gets to grow with significant tax advantages, which supercharges its growth potential over decades. Starting this early, even with just $20 or $50 a month, can make a monumental difference by the time you retire. Number 7 is to consider peer-to-peer lending, or P2P lending. This is a more modern way to invest. P2P platforms connect investors like you directly with individuals or small businesses who need to borrow money. You essentially become the bank. You can invest small amounts, sometimes as little as $25, into a fraction of a loan. As the borrower repays the loan with interest, you get your principal back plus a return. The interest rates are often higher than what you'd get from a savings account or CD. Of course, there is more risk involved, as a borrower could default. But by diversifying your investment across many different small loans, you can significantly mitigate that risk. It's an interesting alternative for those looking to diversify their portfolio beyond the stock market. 8th on our list is to invest in your own education and skills. This might be the highest return investment you ever make. Unlike the stock market, the value you build in yourself can never be taken away. Use a small amount of money to buy a book on a valuable skill, take an online course in a high-demand field like coding or digital marketing, or get a certification that can boost your career. Increasing your knowledge directly increases your earning potential. A higher salary means you lines have more money to invest in all the other strategies we were talking about. Don't ever underestimate the power of betting on yourself. It's an investment that pays dividends for a lifetime. Our 9th smart move is to explore fractional shares. Back in the day, if you wanted to invest in a big-name company like Amazon or Google, you needed thousands of dollars to buy just one share. That was a huge barrier for most people, but now, thanks to fractional shares, you can own a piece of these companies for as little as $1. Most major brokerage firms now offer this. So, if a stock is trading at $1,000 a share, you can invest $10 and own 1/100th of a share. You still get the benefits of its growth and any dividends it pays, proportional to your ownership. This democratizes investing and allows you to build a diversified portfolio of companies you believe in, without needing a fortune to get started. Finally, our 10th and perhaps most crucial move is to automate your investments. This is the secret ingredient that ties everything together. Consistency is more important than amount. It is far better to invest $50 every single month without fail than to invest $500 once and then forget about it. This strategy is called dollar cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high. This smooths out the ups and downs of the market and can lower your average cost per share over time. Set up automatic transfers from your checking account to your brokerage or retirement account on payday. Make it a bill you pay to your future self. This removes emotion from the equation and ensures you are consistently building wealth in the background, without even having to think about it. So there you have it, 10 actionable, smart investment moves you can make even if you're starting with a small amount of money. The key takeaway is to just start. Don't wait for the perfect time or for a big windfall of cash. The power of compound growth means that the sooner you begin, the more time your money has to grow. Pick one or two of these strategies that resonate with you and take that first step today. Whether it's opening a high-yield savings account, downloading a micro-investing app, or setting up that automatic transfer to your IRA, every small action you take is a huge step towards securing your financial future. Thank you so much for watching. I hope you found this helpful and feel more empowered to start your investing journey. If you did, please give this video a thumbs up and hit that subscribe button for more content just like this. And I'd love to hear from you in the comments below. Which of these strategies are you going to try first? Thanks again, and I'll see you in the next video.